question on this. Okay, so this is what we discussed, right? If you talk about the J's that we just spoke about with Ritika, the initial recognition. So how are you going to bring the investment in your books? Initially, when you purchase the asset, you're going to take the purchase price. So if I buy stock, I'm going to take the purchase price plus all the costs directly related to the purchase, like brokerage fees, transfer fees, even transaction fees. But that's only for initial recognition. Subsequently, if you're incurring any cost on the security, it will be expensed, it will not be capitalized. Then what are you going to do? Subsequently, you're going to mark it to market, and all the unrealized gains and losses you're going to show in the income statement. Since you're anyways adjusting it to the mark to market figures, there is no concept of impairment. The money that you're going to get from the non-liquidating portion, that means out of earnings and profits which are either current or accumulated, would be called as dividend income, and the J for that is going to be cash account debit to dividend income, and you're going to put this in your income statement. And in case if the company is giving you a return which is not out of the current or past accumulated earnings and profits, then you're going to debit cash, but you cannot credit the P&L, you're going to credit the investment account. So that is subsequent measure. How are you going to report it in your books? In the balance sheet, generally, if it is for speculation and you're going to consume it within one operating cycle, you're going to call it a current asset. However, if it is supposed to be held for a sufficiently long period of time, it will be classified as a non-current asset. So if you guys understand, there's no concept of AFS equity securities, right? So here it's a cusp between both the trading as well as the AFS securities. The yardstick is the intent. Why are you holding it? In the income statement, you're going to credit the income which is coming from dividends, and also you're going to credit all the mark-to-market gains and losses, which are called unrealized holding gains and losses. In the statement of cash flows, generally when you're buying investments, unless and until you're buying to sell it in the immediate near term and it is going to be held for speculation, in which case you're going to classify it as an operating activity. The general rule, whenever we are buying investments for equity, we are assuming that they're going to be held over a long period of time, and we are going to classify them as an investing cash outflow. Okay, look at this question. Let's do it together. It's very easy. Step by step, you're going to take one question at a time and understand those concepts. You're supposed to pass necessary journal entries to reflect the above transactions in the books of Alpha Company. On January 1, there's a company called Alpha Company purchased 300 shares of Beta Company for 50 per share. This accounted for 10% of the shares of Beta Company. So the moment you know it's 10%, you should tell yourself there is no significant influence. That means the accounting general rule is fair value through net income. Beta Company paid dividends at the end of the year for 120 when its retained earnings was $90,000. So I know some part is coming from liquidating, some part is non-liquidating dividend. On 31st December, that means at the end of the year, the company was trading at 26 per share, and the investor decided to liquidate all the shares at 25 per share on January 5th, the next year. So please write the answers in the chat panel, okay? So when I'm going to buy the shares on January 3rd, I'm going to debit investments in Beta Company and I'm going to credit cash. Please do that. How many shares? 300 shares, and I'm buying them at 50 per share. So this accounted for 10%. So in my mind, I should know that we have 10% shareholding in the other company. The company paid dividends at the end of the year. So basically December 31st, I got the dividend. How much? I have 10% shareholding in this company. So I must have received $12,000. Which is a big thing, right? So I received cash. How much? I'm not seeing anybody writing answers in the chat panel. Please write your answers in the chat panel. So when I receive the dividend, I'm going to debit cash of 12,000. But out of this, the dividend income can only be coming out of current or past accumulated earnings and profits, which is reflected in the retained earnings. So 10% of the retained earnings is $9,000, which is going to be my dividend income. And the balance, 3,000, is a liquidating dividend where I have to credit my investment in Beta account of 3,000. And this is actually a liquidating dividend or in reg language, it is return of capital. Now again, 31st December, which is at the end of the year, I'm going to mark this security to market, which is fair value through net income. So I will suffer a loss of how much? $50 per share minus the market value on that day. But if you see how much has been the investment, it is not 50. I've already reduced the investment. Do you realize this? Can you tell me how much is the loss on revaluation? When you're marking it to market, what is the loss? Can you tell me how much is the loss on revaluation? So there are two ways of doing it. Find out the full figure and then reduce 3,000. Or it is already 15 minus 3. So your investment is now already at 15 minus 3,000, which is 12K. And now the market value of these investments is 300 shares into 26 per share, which is how much? So we have 300 shares into 26 per share, which is $7,800. So the unrealized loss is going to be 12,000 minus 7,800, which is $4,200. So what is the entry that you're going to pass in your books? It is unrealized loss on beta company, 4,200 to valuation allowance, 4,200. Please remember, this is fair value adjustment. Last entry. I want the last entry, guys. On Jan 5th next year. On Jan 5th next year, can anybody tell me what is the JE that I'll be passing in my books? I need the full JE. And remember, I know everybody understands the concept, but I want to know what is the full JE in the books. Who's going to take it for us? Raise your hand. Vishnu, you want to try? What am I saying? Debit credit. Yeah, take the question. Tell me, what is the JE that I'll be passing?
The sale of
Yes.
cash account debit.
How much?
25 into 300.
Which is 7,500, right?
Yeah.
Then?
And realized loss on fair value.
So this is realized loss.
Yeah, realized loss.
Unrealized. So be very careful. We are actually selling it. So it is not unrealized. It's realized loss on shares. How much?
300.
How did you get that? So 26 minus 25, right?
Yeah.
Into 300. So we booked a loss of 300 in our books. Okay.
Valuation adjustment account. Valuation allowance account debit.
Very good. So you had valuation allowance in your account, which you're going to reverse of
4,200.
4,200. And you're going to remove the investments from your books at
12,000.
12,000. That's it. It cannot go tougher than this when it comes to fair value through net income. We have taken dividend, we have taken liquidating dividend, we have taken fair market value increase, we have taken sale, realized gain, unrealized gain, everything we have taken in the picture. Is this clear? Everybody. Vishnu, by the way, I do understand the relevance of your question now. You were correct. I think in terms of terminology, see, at a bigger bracket, always the difference between fair value and the cost is considered an unrealized gain or a loss. But the moment you're taking impairment into the picture, we need to compare it with what you're going to get in the market. And then the figure that actually goes and gets posted in the P&L will be termed as impairment loss. So you were correct. Okay.